Welcome back. Let's talk markets. Varun, Goel, head of equity at Nippon India AIF, is here with us now to talk about the market setup. Varun, morning, and thank you very much for joining in. Rima here. How are you feeling about the markets? What have you made of this incredible rally that we've had, 5% in the last 1 month? These kind of valuations, does it make you a bit uncomfortable? Because many mutual funds are choosing to use this opportunity to just lighten up their position, increase their cash holdings. Your thoughts on the markets at these current levels, approaching almost 20,000 now on the Nifty?
Yeah, good morning, Rima. Thanks for having me on the show. I think if you look at the markets, we've had a very, very sharp rally in the last 3 months with Nifty moving up 12-13%, small and mid cap space moving 15 to 20%. Our sense is, if you look at the broader markets, they are fairly valued. We are looking at 19 to 20 times 1 year forward earnings on valuations, which you can say 8 to 10% premium to the historical average. So broadly, from this point onwards, we would be very stock selective, do more bottom-up stock picking. If you look at the valuations of the large cap space and the mid cap space, the valuations are broadly similar. But for the large cap space, we would expect 14 to 15% earnings growth in the next 1 year. While for the small cap space, we believe earnings growth can be faster, considering the fact that they were most impacted because of interest rate increases and commodity price increases. As both these things start to cool off in the next 12 to 18 months, we expect earnings growth in the small and the mid cap space to be slightly higher. Therefore, that's one pocket of the market that we continue to be constructive on. So broadly, we are looking at low single-digit return for markets in the rest of the year as far as Nifty is concerned, while the mid and the small cap space can do better.
Okay, got that. Hi, Varun. Thanks for joining us. If you can just get a little bit sector specific now, we've got some of the banking earnings which have come through. HDFC Bank was, of course, good. IndusInd yesterday was very good as well. We've seen a margin expansion in both of these when there were expectations of a contraction as well. How do you think this space is likely to fare from here on? And do you expect a similar move in the rest of the big banks that will post results in the next couple of weeks?
Well, whatever results we have seen or the quarterly commentaries that we've seen are quite good. I think we expect the banking sector to continue to be a driver of corporate earnings for this year also. So last year, FY23 was the first year after FY13 where we recorded a 15% credit growth. And I think even if we see some moderation this year, let's say 13-14%, the credit growth will still remain quite constructive. Broadly, we expect NIMs to be stable. Considering the fact that we are broadly at the end of the interest rate tightening cycle. So we expect margins to be similar, but the provisioning cost or the credit cost has continued to come off. And on that basis, we continue to see a 15 to 20% earnings growth for large cap names. The small and the mid cap names can actually deliver a faster earnings growth, considering the fact that the credit costs are coming down even more. So broadly, the outlook for the banking space remains quite constructive. I think this year, even the non-bank financials, be it asset management companies, brokerages should also benefit from the revival in equity markets, and even the non-lending companies should also do well this year.
Okay, that's on the financial side. Just wanted to get your take on this whole theme around defense, manufacturing stroke defense, because we've already seen a huge run up in prices. So would you start looking elsewhere? And if yes, then, what other pockets interest you when you're talking about playing the whole capex theme?
So I think there's no doubt that the capex theme has run up quite a bit and time to be a little more cautious and careful there. I think as far as the earnings growth are concerned, for some of these PSU names, the earnings growth should be quite robust in the next 2 to 3 years, considering the fact that they're carrying very, very large orders. But I think market is largely pricing that in. And from this point onwards, we have to look at those companies which are going to get incremental order inflows and where the earnings delta can be higher. But broadly, most of these companies are trading at a fair valuation. As far as capex as the story is concerned, there are still some companies in the small and mid cap space which should see expansion of margins. I think whether it's bearings, whether it's gears, whether it's pumps, compressors, some of that capex activity continues to be pretty robust across the country. We should see a 15 to 20% top line growth, and the fact that the margins can recover from last year because they were impacted last year because of high commodity prices. So overall, some of these small cap and mid cap names can continue to see good earnings traction as far as the broader capex theme is concerned.
Varun, we'll leave the conversation here. A little short today, but thank you very much for joining in. Need to get into